we will start the presentation. So first, initially, we will see the presentation. Then we will have this monthly recommendation. After that, we will have question and answer session. In question and answer session, please type the question. I will try to answer as much as possible. So Nifty, if you see in the last month, has effortlessly crossed 17,000 levels. So mainly in the last 1 month, it was led by large cap stocks. Stocks which were underperforming for the last 1 year, they have started doing well. For example, Reliance, which was underperforming for many months, that has done very well in the last 1 month and has crossed previous all-time high. Similarly, if you take Bharti Airtel, which was lagging for many months, they also has come to all-time high. So underperforming stocks has done well, which gave support to the Nifty, and the Nifty crossed 70,000 level effortlessly. Similarly, Sensex has crossed 58,000 level. But if you see the broader market, it was a mixed performance because last month broader market fell very sharply. Mainly many large caps and mid caps, many mid caps and small caps fell very sharply. But majority of them has rebounded. But still, when relative to Nifty, if you see the last 2 months, if you see means Nifty and Sensex has done relatively better than mid and small cap stocks. So broader market still remain very stock specific. And the interesting thing happening the last 3-4 days is that index, large cap index is consolidating, whereas individual stocks, very stock selective, they were doing well. Some of the stocks in the mid and small cap space, they have done well in the last 3-4 days, but it is not across the board performance in the broader market. Globally, if you see US market, they are still doing well. Only the last 2-3 days, it was some lag was there in the Dow Jones and Nasdaq. Whereas if you see overall US market is also doing very well. And the big highlight on liquidity front is that FIAs, they are not buying heavily, whereas in mutual funds we are seeing very good inflows from domestic retail investors. SIPs, which is systematic investment plan, where people are putting a lot of money. And if you see in the last month, SIP flows has near to 10,000 crores per month. 10,000 crores per month means almost 1.2 lakh crore it will come per year. So it's a big inflow into the domestic mutual funds, where the majority of them were small retail investors who used to put 1,000 rupees, 2,000 rupees, 5,000 rupees every month, because the bank interest rates were very low. Some of them are thinking of putting some small long-term money into the SIPs. Generally, the SIP flow are long-term money. They used to stay for 5 years, 10 years like that. And many of them are happy even if they get a 10-12% annualized return, because bank interest rates are coming to 6%. And if you see the post-tax return, it comes to around 4.5% only. So when you compare to that, even if they get a 10% post-tax return, they are very happy. That is why we are seeing very good inflows into the domestic mutual funds through SIP, which are basically a long-term money. And 2 NFOs has done very well consecutive months in the last 2 months. One is the ICICI Flexi Cap Fund. They are able to garner nearly 10,000 crores in the month of July. In August, SBI came with an fund, which is the mix of equity and debt fund. That also has collected more than 10,000 crores. So overall, it has been a very good inflow into the domestic mutual funds, and they are giving support to the market. And they are giving good support to the market. If you see the ICICI Flexi Cap Fund, which collected nearly 10,000 crores in the month of July, in the month of August, they have invested around 68-70% of their fund. That means almost 7,000 crores they have put in the market. So any FIA selling comes means the domestic mutual fund, they will give support to the market. So it's a big positive for overall strength for the market. It will reduce volatility, big volatility in our market. And Nifty and Sensex, if you see in the last 1 month, they have gone up by nearly 5%. Mid cap also, mid and small cap also has gone up by 5-6%. But the difference is that Nifty and Sensex did not corrected in the month of July. Whereas if you see mid and small cap, they have corrected in the month of July and August little bit. From that, they have bounced back. So overall, mid and small cap, even though they have bounced back, relative to Nifty and Sensex in the last 2 months, if you see, means Nifty and Sensex, they have done relatively better in the last 2 months. After many years, we are seeing some strength in our macro data. So basically, if you see domestic macro data, there are 3-4 data which everyone used to see it very closely. One is the fiscal deficit number, the second one is the inflation number, and third one is the trade data, where export and import data is to come. So if we leave aside inflation, the other two data are extremely positive for our macro economy. If you see the tax collection, we are seeing a very good collection in taxes for the government. And this is the chart where government has released from April to July. Almost 4 months of tax collection the government has released. And in that, if you see that in the first 4 months of current financial year, government able to garner almost 35% of their budget estimates. B is the budget estimates. And if you see that the government could able to garner almost 34% of the entire year collection, they could able to get it in the first 4 months. When you compare to previous 4 years, if you see, last year it was very bad, mainly because last year COVID first wave was there and country was undergoing an entire lockdown. So last year it was 12, but when you compare to previous 3 years, it used to be around 20%. First 4 months, government used to get around 20% of the budget estimates of the tax collection. Whereas if you see in the current financial year, it is almost 34% that they have collected in the first 4 months of the financial year. FY22, they have collected almost 34% of the budget estimates in the current financial year in the first 4 months. So after many years, we are seeing that the tax collection has been extremely healthy. So in tax collection, if you see, there are 3 major segments of that. The first one is the GST collection, where government used to collect the GST, and it will be divided between states and center. The second one is the corporate tax. Everybody will be known that 2 years back, government has reduced the corporate tax. In spite of reduction in corporate tax rate, government could able to collect more money in that. And third one is the excise duty. Basically, it is collected from petrol and diesel fuel price, and the government could able to get a huge sum of money in that. And that money is mainly spent for infrastructure. Government is spending. Excise duty collection is not shared with the center, whereas the corporate tax and the GST, it will get shared with the between the center and state. While excise duty, it is fully enjoyed by the central government. And because of very high collection in the fuel taxes, government could able to get it lot of money. And overall, all the 3 segments has done well. GST collection is very good. Corporate tax is very good in spite of lowering of corporate tax 2 years back, and the excise collections from fuel, it has also been very strong. So under our 3 heads, it is very good, and government could able to get a good share of tax collection. And this is happening after many years. The tax collection is well above the initial government estimates, and compared to previous also, it is very good. But what is surprising is that government has spent less money when compared to previous years. If you see the government spending as per budget estimates, it was just 28.8% only government has spent money in the first 4 months. Last year it was 34.7, and previously if you see that it was above 30%. Whereas this year, in spite of very good tax collection, government hasn't spent much money. They are waiting for the private enterprises to spend money. Recently, government has announced many PLI schemes where they are going to give incentives for new manufacturing units for export substitute and for exports. And government expects that the private sector capex will kick on. So that is why government spending has come down when compared to previous years, in spite of very good tax collection. So what is happening when tax collection is high, whereas spending is less, means naturally what will happen? Fiscal deficit will come down. Fiscal deficit is nothing but the difference between government revenue and expenditure. Because of very high tax collection and lower spending, the fiscal deficit has fell very sharply when compared to previous year. If you see the fiscal deficit April to July, that is the first 4 months of current financial year. If you see that the but out of on the budget estimates, just fiscal deficit government has done just 21.3% only. Previously, historically, if you see that government used to achieve the fiscal deficit target much earlier, in 4 or 5 months, they used to achieve the entire fiscal deficit in the first 4 months. And after that, what used to happen is government spending will come down because it will lead to a higher borrowing. But this time, what has happened is that because of very high tax collection and very low expenditure, the fiscal deficit is very, very low. Just 21% of budget estimates, it is for the first 4 months. Whereas previously, if you see that last year it was 103%, and in previous month also it is well above 90%. Previous 3 years, if you see that it is well above 90%. So the fiscal deficit is very strong. So only thing what government has to see is that in order to control fiscal deficit, what they have to do is that the PSU divestment 1.75 lakhs they have targeted for current financial year, that has to be achieved. Suppose if government misses that target, means then naturally fiscal deficit will go up during the current financial year in spite of achieving the targeted tax collection and a lower spending. So government should keep focus on the PSU divestment, and 1.75 lakh crore they have set the target and they have to achieve it in order to lower the fiscal deficit. So LIC will be very crucial because government is targeting nearly 1 lakh crore on LIC divestment. It is expected that 50th government wants to do it in 2 tranches. The first tranches is expected to be around 50,000 crores, and the second tranches it will be expected around another 50,000 crores. Government has already appointed 10 lead managers as well as registrar for the LIC IPO. We are expecting the LIC IPO to come in the next 3 or 4 months. And till then, what I am expecting is that market will be relatively stable. We are not going to see huge fall unless there is a crash in the global market. This is the GST collection, and if you see that GST collection relatively stable, and in spite of second wave we had, the GST collection has been good. Only in the month of June, it has been lower than 1 lakh, and in all above months, it has been well above 1 lakh. During May, June, July only, we had a huge second wave affecting the country. But in spite of that, GST collection has been good. And this is the export data chart. So in the previous presentation also, I told it that Indian exports are doing well. And last month, in the month of July, we had a record highest ever monthly export data of $35 billion. And the last month, if you see that, it was 33. Though it is lower on a quarter and month on month basis, still when you compare to year on basis, it is good. Any data above 30 billion is good for our country, which indicates that we are doing well in the exports. And if you see in the last 6 months, if you see that India has been consistently exporting more than 30 billion worth of goods to other countries, and which is very positive because in India, if you see that we have a very good domestic market. If exports does well, means it will give very big tailwind for our economy, and we are expecting exports to continue to do well in coming months also. And the many PLI schemes, many companies have already signed with the government for putting plants under PLI scheme, where government will give incentive for exports as well as for import substitution. And if that start kicking in, means that also will start contributing exports, but that will take around 6 to 1 year time to reflect in our exports data. But at present, if you see that exports are doing well, many sectors were doing well. Textile is doing well, chemicals are doing well, engineering are doing exceedingly well, and in apart from this export, the in services export, IT is doing well. So overall exports continue to do well, and which will be a big tailwind for our economy. In the initial comment, I told that there are a lot of money coming into the mutual fund through SIP, and SIP inflows has touched near to 10,000 crores per month. Around 9,900 crores it has come. Most probably in the next month we will cross the 10,000 crore barrier. It will be a big milestone for our mutual fund industry as well as for domestic capital markets. And the other thing which everyone watching very closely is the new demat account opening, because somebody who has to enter into the market means demat is a must, because without demat you cannot buy or sell any shares, and for that demat account is a must, and a number of demat account opening will give you a very good idea of how new investors are getting into the market. A good healthy market is one where we have more participants, and is there, and more new participant also has to come. In that way, if you see that new demat account opening is at record pace, it has been happening. When you compare around 8 years back, if you see that in FY between FY 13 and 14, 2 crore demat account was there at that time. So from FY 13 and 14, if you see that 1 million demat account, that is 10 lakh demat account was opened at that time per year. That got increased to 20 lakh, that is 2 million in FY 15 and 16. From 2.3 it went to 2.5. And if you take another 2 years down the line, if you see FY 18 and 19, it became 4 million. And if you see the last financial year where COVID got impacted, if you see that almost 1.4 crore new demat account has been opened. And if you see the journey, if you see means in it was 10 lakh, then FY 15 and 16 it was 20 lakh new demat accounts, and FY 18 and 19 it was 40 lakh new demat account. And if you see the last financial year, almost 1.4 crore new demat accounts got opened. From 4.1 crore demat accounts, it went to 5.5 crore demat accounts in our country. And if you see the current financial year in the first quarter, almost 1.7 million, that is 7 lakh account has been opened. So the last full year we opened 1.4 crore, whereas in the first quarter of current financial year, 0.7, almost 50% what we have opened last year. If you when compared to last year, if you see almost 50% new accounts has been opened in the first quarter itself. So this indicates that more and more demat accounts are getting open, and more clients are coming into our market, and it is very positive for a long-term perspective also. Even this is very less when you compare to a country like China and US. If you see US in population terms, if you see, we are a country with 130 crore people, more than 130 crore. And if you see the number of demat accounts, it is just 6 crore demat account is there. That is not even 5% population has opened demat account in our country. When you compare to US, it is almost 30-40% is there. Other European countries also, it is far higher. And some of the countries like China also, it is multiple times higher than what we have the penetration level of demat accounts among the population. So still a long way to go. We are less than 5% still now. And I am expecting around 10 to 15% of our population to open demat account in the next 5 to 10 years. So that is the reason why the stock CDSL continues to do well. It was trading around 300 rupees just 1 year back. Now it is around 1,300. Due to trading restriction, the stock price has cooled and has corrected a little bit. But if you see the long-term prospects, they have a very good long-term prospects. So it's a duopoly market. Demat account is only two players are there. One is the NSDL and second one is the CDSL. CDSL is a listed one. NSDL not yet listed. Most probably they may also get listed in our market in the current financial year itself. The way the demat accounts are getting opened, the way the number of SIPs are coming into the market, it gives enormous confidence that in a long term, our market will do well. The rally we have seen in our market in the last 1 year is nothing when you compare for the next 10 years, 15 years. The prospects are very bright. And if you see that even the AMC companies, 3 AMC companies are listed in our market, which are the in India as well as HDFC AMC and UT AMC. Their stock also doing well because the penetration level is very less in our market, both mutual fund and the demat penetration. And when compared to other countries, it is far, far less. So the long-term prospects are very good for the financial savings industry. This is the mutual fund data. And if you see that when compared to previous month, the inflow has come down. It is around 9,000 crores. One of the reason why it has come down is that the last month, the month of July, we had an flexi cap, ICICI flexi cap NFO, which garnered almost 10,000 crores money in that. That is why we have seen a huge spike. Last month, what happened was that SBI balanced fund IPO came, NFO came, and they could able to get 12,000. Since it is a balanced fund, that amount is not get added into that because only the UPT portion only has been shown in this graph. If you add that means it will surpass the previous month inflow. Both balanced fund and equity, if you add when compared to last month means previous month, in the month of July when you compare, this bar also will get higher than in the month of July. So the strong domestic inflow is coming into our market overall. Foreign inflows, they are neither selling nor buying in our market. Few days they are selling and few days they are buying. Ultimately, it is almost nil inflow. And if you see in the financial year 22, almost is a nil inflow in the first 5.5 months of current financial. If you see means almost zero inflow. Last few days, what is happening is that few days they are buying the market and then few days they are selling in the market. Ultimately, it is a nil inflow from the foreign portfolio investors, whereas the domestic retail investors, they are very active directly as well as through mutual fund. Just a few years back, 7-8 years back, if you see, means Indian market was entirely dependent upon the foreign portfolio investors. If they buy means market used to do well. If they sell means market used to do very badly. Now, if you see that between FY 11 and 15, our market did relatively well. FY 13, 14 and 15 did relatively well because of a very high inflow. Whereas 18 and 19, the broader market did not did well because of lower inflows. Whereas now, if you see that in spite of nil inflow from foreign institutional investors in the last 5.5 months, our market has done relatively better, mainly because of support from domestic investors as well as from mutual funds. So as a country, we no longer heavily dependent on foreign portfolio investors now. This is the Nomura Business Reception Index, and this index which used to calculate how our economy does pre-COVID as well as post-COVID. And if you see that the last print we have got is that 101.2. That means we have gone to our economy has jumped to the pre-COVID level. So pre-COVID level, they have took as 100. From there, they have calculated it. And when the first wave came, it fell to almost to 46.5. That means almost 50% of our economy got standstill. Less than more than 50%. It fell to 46.5. Then when unlock happened, it gradually started opening. It started going up, and we saw in the month of February, March. If you see that it came to 99. Then the second wave came. It fell very sharply to 60. From there, it bounced back. Now it has come above the pre-COVID level. So this chart clearly indicates that business has overall business has come to pre-COVID level. And what is interesting to see is that the second wave is a clear V-shaped recovery. It fell very sharply, but still higher than what we have seen in the first wave. But it recovered very sharply. So a clear V-shaped recovery we had in our economy in the second wave. and a very sharp fall as well as sharp pullback, and we have come to the pre-COVID level. Whereas in the first wave, if you see that economy took some time to recover from almost 6-7 months it took for recovery from April, May to January, February only it got recovered. Whereas the second wave barely it took 2-3 months only. It has come to the pre-COVID level, which indicates that second wave did not affected much for our economy. Monsoon update. Generally, I used to put the monsoon data every time during the monsoon season, and this time before monsoon, both IMD and private forecasters came and they told that this time the monsoon will be good, but unfortunately it did not went as per the forecast. And then both IMD and SkyMet they revised their estimates, and then what they did was that IMD told that that the monsoon will be lower end of normal. That is, monsoon is expected to be 94-95% of long-term period average. SkyMet said that it will be slightly below normal. They have told it. August was a very bad month. So 4 months of southwest monsoon we have: June, July, August, September. July and August are the rainiest month among the four. June and September used to be less rainful. July and August are the rainiest month. So what this time happened was that June was very good. It was 10% above normal. July was bad. It was below normal. August, what has happened was that is one of the worst August we had for last many years, more than a decade. And if you see that almost 24% rainfall was less than the normal long-term period average. And in September, it has recovered, and in September, it is expected that it will be above or surplus month. And some of the shortfall we had in the month of August will be made up in the month of September. The other interesting thing among this time monsoon is that May, the June, July, August, September was the 4 months of monsoon. Whereas pre-monsoon, if you see that the month of May, we had one of the rainiest May month. That is, pre-monsoon rain was extremely good. So even if we get 94-95%, it is nothing to worry. Though officially it will be told that it will be below normal monsoon. Whereas if you take the May month rainfall also into account, means in the 5 months overall we will have a decent monsoon. And as on September 8th, if you see that almost 7% shortfall is there on the long period average. South, it was surplus by 14, but all other categories, Central India, it was -11, Northwest India, it was -14, East and Northeast India, it is -10. So overall, it is -7% from a long period average, and it is expected that the shortfall may get reduced to -5 in coming days, because September is expected to be a good month. So even though it is less than a long period average, it is nothing to worry. We expected that the sowing will pick up in coming months. It is already well above normal sowing, but still we expect that the agriculture output is unlikely to fall in spite of lower rainfall. The other interesting thing which has happened in our country history is that India has done very well in Tokyo Olympics and Para Olympics. Why I have put this slide is that if you take any country which has done well in the economy, if you see that they used to do well in sports also. Though the direct relation between sports and economy cannot be established, a country which is doing well in economy, they used to do well in sports also. And if you see that for India, we had a best ever medals tally in Olympics in the just concluded Tokyo Olympics. In Para Olympics, we have done much better than the Olympics, and our medal tally is the highest ever in both Olympics and Para Olympics. though we could not able to establish the direct link between economic growth and sports. You take any country which has done well in economy, they used to do well in sports also. So what I feel is that the Olympics is just concluded. Tokyo Olympics will be a turning point for our country, and we will do well in both economy as well as in sports in coming years. So my initial comment I told about this LIC IPO. The LIC IPO could hit the market in the next 3-4 months, and it is going to be the biggest ever IPO we have seen in our lifetime till now. Previously, the highest IPO we have seen is the Reliance Power and Coal India, and this time this LIC IPO is going to be the multiple size of what we have seen previously. And generally, what used to happen is that whenever an IPO comes, a big IPO comes means the related companies used to do well. So we don't know who is buying that and why the stock price used to do well. That and all we don't know. But still, whenever a company, for example, LIC is an insurance company. So when a big insurance company comes with a very big IPO means all insurance stocks used to do well. We have seen in 2007 that when Reliance Power used to come, when came with an IPO, at that time all power stocks did well at that time, and company related to ADAG, the Anil Ambani group, did very well at that time. We don't know who is buying that and who is pushing up the price. That and all we don't know. But it used to happen historically in the market. Any big IPO comes means company related to that used to do well. And what my feeling is that all insurance stocks will do well during the LIC IPO time, as well as since LIC is a PSU company, I'm expecting that PSU as a theme will do well. It won't give huge returns like chemicals and IT companies, but still it will do relatively well. So the PSU theme I'm expecting to do well. It should be seen as an tactical move only. Just during IPO and just before IPO, it will do well, and after that, individual companies will do well as per their fundamentals. But in the meantime, what I am expecting is that next 3-4 months, the PSU team will do well. It won't give huge return, but still relatively it will do better than what we have seen in the last 6 months or 1 year. So one index which has done very badly in the last 10 years, 15 years, if you see that the this BSE PSU index, which consists of only PSU stocks, and in spite of Sensex doubling or more than going up by 150, 175% between 2007 and now, this S&P BSE PSU index still lower than the level what we have seen in 2007. That is, for 14 years has passed, still PSU index is lesser than what we have seen in 2007. So then we may see some improvement in the PSU stocks in anticipation of PSU LIC IPO, and it should be seen only as a tactical move, as a short-term move. Long-term, the individual companies will do as per their fundamental improvement. So one way to participate in the PSU theme is to buy Bharat 22 ETF, which is run by ICICI. It consists of only PSU stocks, and it has a diversified portfolio. Instead of buying individual PSU stocks and finding which will do well, which will do bad, one best way to participate in the PSU theme is buying the Bharat 22 ETF, which consists of only PSU stocks. And second wave, if you see coming to the COVID second wave, if you see that in our country, after peaking around 4 lakh cases, if you see that now cases are plateaued in our country, and more than 60-70% of cases are coming only from one state, that is Kerala. Kerala government is trying to vaccinate everyone, but still cases are very high when compared to other states, and a daily contribution to entire national tally is around 60-70% Kerala contribution. We expect Kerala also the cases will start coming down in coming days because of very high vaccination, and people are extremely careful and putting double masks. whereas some of the states like Madhya Pradesh, North Indian states, Rajasthan, Gujarat, and all, the daily cases are less than 10 per day, which is very surprising. Because these states which was affected heavily during the second wave, there almost complete eradication was there in these states. Less than 10 cases in a state means almost it is equal to zero. Yesterday also I checked state like Madhya Pradesh, the cases are just 5 cases only they have got yesterday, which is very surprising. And overall cases, if you see throughout the country, it has plateaued. It comes around 40,000, around 40,000, and among them, it is mainly contributed by Kerala only. Almost 60-70% is contributed. When Kerala cases goes up, all India cases goes up. When Kerala cases comes down, all India cases comes down. But overall, when compared to other countries, we have done relatively better in number of cases, and vaccination also happening at a very rapid pace. Around 50 to 1 lakh crore daily vaccination is happening, and if that pace continues means India will in the next 3 months majority of the population will get vaccinated. Global cases, if you see that almost it looks like a third wave when you see the global cases. First it went up, then fell. The second wave came, it fell. Now again it is going up. In some of the countries like US and all, the cases are going up. Mainly it is affecting the children there. But overall the number of death has come down, which is very good. What experts are telling is that COVID is not going to leave us for the next 3-4 years. Only thing what we have to see is that death rate should fall, as well as the infected person should not be very serious. These two things every country is taking care of, where the death rate should be as low as possible, and the people who are admitted in the ICU wards, it should be less. If these two comes down less than 1% means, then world will start going as usual, because the COVID is not going to come down. It is not going to become zero for the next 3-4 years. It will be mild infection, and then it will go away, and then it will be infected to other person. They will also get mild cases. Like that, the time will go on, and we have to live with it. That is what majority of the experts were saying. One important thing which has happened in the global market is the action of the Chinese government. Recently, Chinese government has took lot of steps, and they are taking steps just as a communist government. China did globalization, started globalization in late 1970s. In 1979, they started globalization. But after 30 years of globalization, now they are seeing in the market as a pure communist country. They are seeing it. They do not want the raw material prices to go up. They don't want the education sector to be seen as a profitable sector. That means just like a communist, how it see the equality they see, they want the Chinese people to be to see equality. They want the difference between people living there to come down. So for that, they are taking lot of steps in their country, which I will see it as a big path-breaking steps. In the last 2 months, what they have done is that they made an education sector as a non-profit sector. Since education is a must for almost all citizens of that country, they want to make education as a non-profit sector. And recently they have banned many video games, so that kids don't get addicted to that. And also they don't want for medical medicine price to go up, as well as housing price to go up. And for that, they are taking lot of steps. And if you see that the latest step what they have taken is that recently many metal prices has gone up because of the commodity price rally. since many of the metals are used in the for construction of houses, construction prices are going up. In order to reduce the construction prices so that it will be affordable to all Chinese citizens, what recently government has did was that government has did a lot of metals from their strategic reserves to cool down the prices, as well as they have banned exports of many steel products, and as well as what they are doing is that they don't want the real estate prices to go up. So just like a communist country where equality will be seen as an important thing, Chinese government is taking this step, and these steps in the last few months, and it is, we have to see how this pan out, because if you see in the last 20 years, China was in the driver's seat as far as commodity prices are concerned. When China exports, China buys iron ore from the world market, means iron ore prices used to go up very sharply. When China stops importing metals, means metal prices used to fall very sharply. So now we have to see how the commodity prices behave now, because Chinese government has clearly gave signal that they don't want higher metal prices. So whatever steps they are taking to cool down the prices, they are trying to take it. They are releasing metals from the strategic reserves. They are banning exports, and we have to see how the Chinese action will make the commodity prices. Right now, the commodity prices are not uh, uh, weak, mainly because of the Chinese action, but because of supply crunch due to COVID, supply side disruption due to COVID, the metal market not yet reacted to the Chinese government actions. Only once the production normalizes, then only we will come to know whether the China is still in the control of global market, commodity market, whether they could be able to dictate the metal prices. Previously, in the last 20 years, they were in the driver's seat of the commodity markets. From here on, we have to see how the Chinese government action impacts the metal prices. Right now, the metal prices are not impacted mainly because of supply side disruption. Even if you see in the last 10 days, aluminum prices went up very sharply. One of the reason why aluminum prices went up very sharply in the global market is that because of who happened in West Asian country called Guinea, because they have the highest aluminum reserves they have in terms of bauxite. Bauxite is the raw material for making aluminum. A lot of reserves are there in the country, African country, Guinea. This bauxite is having, due to the coup recently happened, there is a fear in the global market that supply may get disrupted, but we have to see how this pan out, this China decoupling from the metal prices decoupling from the Chinese market. This is a very interesting chart. Fortune Global 500 companies in the last 2 decades, and if you see that in year 2000, US had 179 Fortune 500. Out of 500 companies, 179 were from US, and it started gradually coming down. As on 2020, it is 124 companies, Fortune 500 companies are there from the US. And if you see the Japan, 107 Fortune 500 companies were there. It has almost become off to 53. The Fortune 500 companies are big global giants. And if you see the other European countries also, Britain, France, Germany, almost it has either gradually come down, or it is standstill. And if you take France, it was it has come down. And France, Britain, and Germany, it was 31, 27, and 22 against 40 and 37 20 years back. European countries also, they have lost their market share in the Fortune Global 500 company. So almost US has lost a market share in the Fortune Global 500 companies. Japan lost, and European companies also lost their status as a Fortune 500 company. But who has gained? If you see, it is China. From just 10 companies in year 2000, now it has gone to 121 companies. Almost 12 times it has gone up. and it is equal to US. So now both US and China are having almost equal number of Fortune 500 companies. These two countries contribute 50% of global 500 companies. And the share of gain, whatever lost by Japan and European countries, entire thing has been gained by the Chinese companies. So China has silently become the superpower, which can challenge both US and the European countries as well as the Japan. So it's a very important thing happening globally. China has gained very sharply in the last 2 decades in the global big companies, whereas entire other countries, US, Japan, and European countries, they have lost market share. It is very important as far as geopolitical is concerned, because for India also very crucial, because India shares border with China, and a superpower sharing border with China, we have to be very careful. Why I am telling at this point of time is that if you take Afghanistan, till now US military used to control it with the help of the old Afghanistan government. Now that has been took over by the Taliban government, and US and entire foreign government military has left that country, and Taliban is now ruling the Afghanistan now. We all know that how Taliban used to behave in the past. Now that could will be the starting point of the geopolitical tension. US and China, if you see that China has become the one of the superpower. Now they have gradually grown uh, and has become almost equal to challenging US. And in Afghanistan, Taliban has formed the government. And what is surprising is that China is aggressively supporting Taliban. So it is very important, because a country which can challenge both Europe and US, they have started supporting Taliban, and which would be very difficult to see. As far as India is concerned, we are sharing border with China, and many terrorist group in the past, Taliban has given huge support to them. And right now, since they formed the government now, initially Taliban will be very soft for the next 6 months to 1 year, because they want to get the global support. Right now, the finances of Afghanistan is very bad. China is ready to lend billions of dollars to Afghanistan, and in order to get other global support, in order to show that the new Taliban is different from what we have seen previously, initially they will be soft, but after 1 or 2 years, once they completely establish the in Afghanistan, then only we will come to know how Taliban behaves, whether they will indirectly support many terrorist group or not. That will be known only after 1 or 2 years. And when China supports Taliban, and China and Taliban coming together, and Pakistan also getting hand with them, means India may get some difficulty after 1 or 2 years. And we have to be very careful. We should not go by the words of what Taliban says or what China says. And government will be closely watching the developments in the happenings in Afghanistan, and what China is doing. And it could well be the point of a new geopolitical tension emerging globally. One important observation I have seen in the last 3-4 months is that, in spite of companies not performing well, the stock prices continuously going up. So, for example, DMart, if you see that without any correction, the stock price is going up consistently. In spite of results were not so average, in spite of stock is trading at a very high valuation of more than 180, near to 200 PE, the stock consistently doing well. And in all bull market, we can see that the high valuations are always justified by some reasons. So in dot-com bubble, if you see that in year 2000, many IT stocks were trading around 150 PE, 200 PE like that. So at that time, the justification given was the a high growth rate these companies were showing at that time. If you see that during 99, 2000 and all, if you see that Infosys used to show 100% growth in their profit and revenue every quarter and every half year they used to show it. And because of high growth rate, what people analysts used to justify that 5 years from now, Infosys from 100 150 PE, Infosys PE will come to 20 30 PE like that. For example, a company trading at a 150 PE, if the next year if they shows 100% growth, means what used to happen is that the 150 PE will come to 75 PE. Again, 100% growth comes, means from 75 PE it will come to 37 PE. So in 2 years time, 150 PE will come to 37 PE ratio. If growth rate is 100% for 2 years, and another year if it shows 100% means, then the PE ratio will come to 18. So a 150 PE stock will come to 18 PE stock if the company shows growth of 100% for the next 3 years. So that is the justification given at the time of dot-com bubble. But dot-com bubble time in year 2000. But once the bubble burst, the growth rate of Infosys fell very sharply from 100 to 30 PE. And similarly, the PE ratio also fell from 100, 120, 130 PE to 30 PE in subsequent years. In that time, in 2001, 2002, the PE ratio fell very sharply. PE contraction came very sharply because of the slow in growth. Now, people are justifying the 150 PE, 200 PE, in the market. Some stocks are trading like that, and in spite of very below expected results. And what they are saying is that the interest rates are very low globally. Many countries are having a 0% interest rate, and liquidity scenario is also very high because every month almost $200 billion quantitative easing is done by bond buying program is done by both ECB and US Fed. So because of very high liquidity and low global interest rate, we should not see PE. We should see the quality of company, and we should see the future earnings. So that is what the analysts are giving justification now for companies trading at a very high PE. But ultimately, in my history, what I have seen is that if not today, some point in the future, valuations will look into the valuations will start coming down for very high valuations. Will all the high PE ratio companies will revert to their mean fundamentals if global liquidity rise or earnings growth disappoints. So that will happen some point of time into the future. So somebody who is having a very high PE ratio shares without underlying fundamentals means they have to be very careful. And once the tide turns means either they should exit it by keeping some trailing stop loss. Otherwise, they may have to hold it for many years to get back their price. And this is the chart of the global liquidity. If you see the balance sheet of three global major economies, one is the US Fed, the second one is the ECB and Bank of Japan. If you see that the balance sheet is continuously expanding. So the initial expansion was done during the Lehman crisis, where the balance sheet increased from 4 to nearly 6.5. Then the continuously quantitative easing was done by ECB and US Fed at that time, and then balance sheet went up, balance sheet size increased. Then between 17 and 20, when economy stabilized, they stopped it. Now again, due to COVID pandemic, they have aggressively increased the balance sheet size. Now it is almost near to 25 level. So that type of liquidity is there in the global economy. ECB is buying 80 billion worth of bonds every month. US Fed is buying 120 billion of bonds every month. So 200 billion of bond buying program is happening between the Fed and ECB, and that is the reason why many companies are getting subscribers at any valuations. So the that because of very high liquidity and easy liquidity, stock valuations are getting supported. many of them are asking me, so when we have to sell it, and what would be the first sign? Actually, it is very difficult to exactly pinpoint which will be the top of the market. And one sign which I personally feel which will give some signal of bull phase topping out is the private equity transactions. If you see that in the last 3 4 years, private equity, lot of private equity transactions were happening in the unlisted space, and that transaction will give the first warning of market topping out. Currently, what is happening is that every successive transaction in the unlisted space, mostly happening between private equity players, are happening at a higher valuation. For example, suppose you take a company, Baiju, which is in the education sector, and if you see in the last 4 years, many private equity transactions are happening, and successive transactions are happening at the much higher valuation than the previous one. And suppose if the valuation fails to go up in the next transaction or falls below in the next transaction, means that will be the first signal that will indicate that market has stopped out, and liquidity have started drying. And we have to closely watch that in the private equity transaction. If private equity transaction in a company happening at a lower valuation than the previous one, means that will give the biggest signal that the current global EC liquidity and current bull phase is nearing the top, and we have to be extremely careful when that happens. In conclusion, and if you see that bull market is intact, and still I feel that our market will do well in the coming months. But in near term, for the next 2 weeks, 3 weeks, like that, I'm expecting some market consolidation to happen. And the month of October, when the earnings starts coming in, we may see again action returning to the market. But till then, I am expecting some consolidation to happen in the overall market, which will be healthy, because just stock price going up without any correction means, when correction happens means, then it will happen very sharply. So some consolidation has to happen, and I'm expecting that the market consolidation will happen in the next 3 4 weeks. But next month in October, once the earnings starts coming in, we may see again market going up. And global market, we have to watch very closely. Any sharp correction in US market happens means, then we may also see some correction. And in the current, in spite of market going up so sharply, I still see a lot of stock specific opportunity are available. In a recommendation portion, I will tell which are the stocks we are very positive on that. He wants to watch COVID cases, we have to watch it, and then we have to see how the foreign inflows comes. Right now, the mutual funds are flush with funds, and they will buy on every dip. And foreign institutional action, we have to watch it closely. Now we will go to the recommendation segment. Thank you. So this time we are recommending 5 companies. The first one we are recommending is the HCL Tech. Previously also we have recommended many times. There are 4 companies are there: Infosys, TCS, then Wipro and HCL Tech. And among the 4, if you see the valuation wise, if you see that HCL Tech is still available lower valuation, and many mid cap IT companies have valuations were extremely high when compared to HCL Tech. So what we feel is that still in HCL Tech 15 to 20% rally is ahead, and one can safely buy into HCL Technology. This year company will post around 50 rupees EPS we are expecting. That is, it is trading around 24 PE now. Both HCL Tech and Infosys both are expected to show same EPS this FY22. And if you see the difference between HCL Tech and Infosys, there is a big difference there in stock prices. And I expect the valuation difference will get narrowed down. And similarly, when compared to Wipro also, if you see that HCL Tech valuations are extremely attractive, and we are expecting 15 to 20% rally in HCL Technology. So investors who want to buy an IT stock means can safely buy this HCL technology. The second one, HDFC Life, as I told previously, that LIC IPO will come in the next quarter. So company which are very big historical IPOs, whenever they come, the stocks belonging to that sector used to do well. Right now, four life insurance companies are listed now. One is the HDFC Life, the second one is the ICICI Prudential Life, the third one is the SBI Life, and fourth one is the Max Life. And if you see, I'm expecting all the four stocks to do well. And among them, HDFC Life recently acquired a company called Exide Life Insurance, and I expect a decent rally in the HDFC Life in anticipation of the LIC life insurance IPO. And recently also the stock has underperformed when compared to other life insurance companies, and valuation gap has narrowed down, and one can buy this HDFC Life. The third one is the NAM India, Nippon Asset Management, and previously it was owned by Reliance Anil Ambani Group. Now the Japan Nippon has took all the complete control of the company. 75% is owned by this Japan Nippon Life, and there will be no corporate governance, and because Anil Ambani Group is no longer is there in the management, and we expect that a lot of SIP money is coming into the mutual fund, and moreover many retail investors are entering into the mutual fund market, as well as the corpus of the mutual funds used to go up and market used to go up. So, mutual fund segment, we are recommending this AM India, Nippon Asset Management. Three companies are listed. One is the HDFC mutual fund, and second is the UTI, and third one is the NAM India. So among them, we are recommending NEM India because HDFC mutual fund is consistently losing their market share, whereas NAM India is maintaining their market share. That's why we are recommending valuation wise when attractive to HDFC mutual fund. So HCL Tech, HDFC Life, and NAM India we are recommending. The fourth one we are recommending is the Canfin Homes. Previously, many times we have recommended the Canfin Homes stock, and I'm expecting the Canfin Home to do well, mainly because they could able to raise the funding at a very lower rate, in line with the HDFC and the LIC. As well as the NPA is far lower than when compared to other listed players like LIC. The NPA is less than 1%. The other important thing is that now the competition in housing finance has come down. Pure housing finance company. Previously, there were two, three very big housing finance companies were there, like DHFL, which gone which is taken over by this Piramal. Then we had this India Bull Housing Finance. Now they are not making any fresh lending. So competition in pure housing finance has come down, and that also will be positive. The other thing why I like Canfin Home is the management commentary is exceedingly positive, and moreover they are concentrated in the Bangalore market, which is the IT hub. Right now, most of the IT professionals are getting higher salary, and Bangalore real estate market is expected to do well for the next 2 years. Among them, the major beneficiary will be Canfin Homes because they are based on Bangalore, and the core market is doing well, which is big positive. Valuation wise also, it is reasonably available in terms of price to book as well as in other parameters of the housing finance. So one can buy the Canfin Homes. And 2 weeks back, we gave in our conviction idea that has achieved target day before yesterday, but still over next 6 months, we are expecting Canfin Homes to do well. The last one we are recommending is Finolex Industries. Basically now the consensus view is that real estate market will do well, and in real estate market if do well means what will happen is the housing building materials that also will do well. Building materials include all these pipe fittings, then the taps, the other things and all. And if you see the Finolex, they have two business. One is the PVC business, and the other one is the pipe business. There is a completely integrated company. Unlike the other companies, they have full integration. And if you see that Phenolics industry caters to both agri sector as well as the real estate sector, and valuations are reasonable when you compare to other players. Astral, the valuation is extremely high. Then you have this Prince Pipe. There also the valuation has gone up very high. Then you have this Supreme Industry. Then the fourth one is the Phenolics industry, where all the four are almost in the same business. And if you see that Phenolics industry is available at a reasonable valuation, the company don't have any debt, and they have backward integrated also through PVC resins. They manufacture it, so they are backward integrated also. One can look into the Phenolics industries because of lower valuations and a strong balance sheet. So these are the 5 stocks we are recommending in this current meeting. Among the last time, TCS and Bharati Airtel did well. SAIL did fell after the result, but one can afford to SAIL. We are expecting that they are deleveraging the balance sheet aggressively, and it will come up. And GSPL and Orient Cement, it hasn't given much return, but still we are very bullish on it. And overall, if you see that the index stocks has done well by giving a good return, both TCS and Bharati Airtel, whereas the mid caps did not did well as expected. SAIL commodity stocks corrected a little bit, but we expect that it will come up. So these are the recommendations.